Welcome to today's podcast, everybody. This is Andrew Wilkinson in the studio with Steve Sosnick, Chief Market Strategist from Interactive Brokers. Welcome, Steve.
Good to see you, Andrew.
Likewise. Now, we thought we'd hop on a quick call to discuss the entire DeepSeek route that cost, I guess, NVIDIA about $500 billion, and then with all of the other associated hardware, software providers, utility companies, it had a massive impact of probably around $1 trillion in market cap. Pretty brutal, Steve.
Oh,
What do you think of the lessons from the episode?
the lessons that I take away here are even disruptors get disrupted. And I think that part of the reason we've come to really make AI a theme, and I say we being just the investment world right now, is that it is a potentially disruptive technology that will change the way we do things, similar to how the internet came into play, call it 25 years ago, and that brings promises of productivity and a change to the way things are done. It doesn't mean just because some of these companies have been staggeringly profitable, that continues. And it's also important to remember that the whole sort of AI theme developed about 2 years ago. And that was when, ChatGPT made its debut, it was October, November 2022. What happened was, as this AI gold rush occurred, we sort of assumed that the ChatGPT type of model was the way that it needed to be done. Massive investments in hardware, data centers, and the electricity required to power all that. And that was also the route taken by other competitors, whether it's Alphabet, whether it was Meta, just even last week announced a $65 billion capital investment. And the government basically committed to $500 billion, although Elon Musk will argue that number's a lot smaller than that. But the bottom line is that was the paradigm. What DeepSeek threatens to do here is, and I say threatens to do because it's impossible to verify whether all their claims are true about coming to life in 2 months and costing only $6 million. There's not a lot of transparency about that. So it's tough to take them 100% at their word. But if AI models can be developed without that sort of massive investment in all the things I just discussed, that changes the game. It doesn't change the game about AI. I'll actually argue it may accelerate the adoption of AI and make it more egalitarian, because it'll be easier for people to use without having to utilize the services of someone who spent billions of dollars building their AI infrastructure. But if you're NVIDIA, I use the gold rush analogy, NVIDIA is the pick and shovel manufacturer for this gold rush. And we've just learned that there's a different different outcome that doesn't require just constantly buying billions of dollars worth of NVIDIA chips. That's why the stock got hit.
And I think NVIDIA, after the close on Monday, a couple of days ago from when we're recording this, they came out with a press release after the rout and said basically kind of the demand for AI is there and it's only going to build and it will require more chips from us. But Steve, what do you think it means for investors bullish on NVIDIA and all the other players in the same game that DeepSeek's AI has been built at a fraction of the cost of ChatGPT?
Well, I think for investors, it's important to understand that maybe a lot of the expectations that have been priced into some of these AI companies, let's sort of divide the world into the AI providers, the pick and shovels, the NVIDIAs, the Broadcoms, but also Digital Realty and Constellation Energy and Vistra and some of these other companies that have benefited utilities and housing and all that sort of stuff.
Mm-hmm.
It changes the game if we don't need all that. And it's a little early to say, but it's telling us that this industry, which had been spewing profits and spewing growth with growth projections into the foreseeable future, maybe those have to be tempered. And the problem you have is going into Monday, NVIDIA was the largest company in the S&P 500 and Broadcom was the sixth largest company. If you change the paradigm for growth for those kind of companies in a highly concentrated market, which is what the S&P 500 has become, when the NASDAQ 100 is even more concentrated, it has no choice but to spill back over into the larger market. And that's really, I think, the consequence. It's very important to keep in mind. I used the analogy to the internet 25 years ago. When the internet bubble burst, Neither Google nor Facebook existed. At that point, we were trading options electronically. Our programming and data was housed on Sun Microsystems workstations. When we needed a PC, we were using Compaq. Our search was primarily Yahoo. See where I'm going here? You can't assume that the current winners will remain winners. For example, it's Wednesday. We've got earnings coming out tonight. People talk about Meta and Tesla and Microsoft, all of which are very important earnings. IBM is coming out too. And IBM was the stock at one point, just because some of these companies, and you know where I'm going with this, Andrew, because I'm going to let you use your new catchphrase. Some of these companies that you think are unassailable can be disrupted.
I remember back in 2001, Steve, it's etched in my memory. There was a visual on the front of the Financial Times showing the market cap of Yahoo at its peak, I think against one of the biggest oil companies, and it had eclipsed the market cap of that. And, very, very quickly that all went away.
Okay, since you're not taking the bait, Andrew's catchphrase, and he messaged me through Teams basically saying, my theme for today is where's the moat? And I did use it in the piece I wrote Monday. And by the way, I have a feeling that should be the title of today's podcast. But I thought that was a 3-word synopsis of what had occurred. I think a lot of the largest companies had built this big competitive moat or anti-competitive moat, depending on your point of view. And the idea of DeepSeek may have showed that the moat is shallower than people thought.
Right, right. We typically talk about moats in the context of value companies that have built up over years their brand equity, and that there's value for investors like Warren Buffett there. And I think people thought that that was happening with NVIDIA, and that nobody could come near them or catch up with them as quickly. And then all of a sudden, bam, DeepSeek becomes the number one download in the App Store over the weekend, and it's front and center and kind of is a real big challenge to that moat. That's the concept there. Steve, we've seen tech stocks traditionally exhibit more volatility, probably for that reason, than blue chips. Was this a classic example of why Nasdaq volatility is greater than S&P 500 volatility?
Typically, it's not exactly apples to apples, but the two things that I always watch, and they're basically like right up there on my market monitor all the time, are VIX, of course, the SIBO Volatility Index VIX, but VXN, which
Right.
is the same calculation, but for the NASDAQ 100. And it's not a given that VXN, that Vixen always trades above VIX, but it typically does. I don't want to go down the rabbit hole of correlation and dispersion, et cetera, et cetera. But if nothing else, NASDAQ is a more highly correlated index. Number one, it's 100 stocks, not 500 stocks. Number two, the biggest stocks, the Mag 7 plus Broadcom, are roughly 50% of that index, as opposed to only a third roughly of the S&P 500. So you have more concentration. These stocks are in many ways more volatile. I wouldn't say that's always the case, because I think, some of these huge mega cap tech stocks function as both growth stocks and value stocks, which is why the market loves them, because they do show a lot of growth. And for the most part, they're relatively highly valued. But if you grow the E fast enough, you can get away with a high PE as long as the E keeps growing. And then it has been. But I think what happened here was with NVIDIA specifically, and it was the idea that their technology was unassailable. And it's not clear that DeepSeek, as you alluded to earlier with the comments from Jensen Huang on Monday afternoon, it didn't invalidate their technology, but what it may have done is reduce the need for quite so much of it. And the problem is when you've got these kind of valuations, when you've assumed the type of earnings growth that's priced into these companies will continue, that's where the disruption came from. Not so much invalidating them, not so much saying that there's this better chip that's out there, but instead potentially a more efficient model that doesn't require so many of the chips. But even there, I've raised this point before. One of the existential questions I've had is, at what point do some of these companies say, we've spent zillions developing AI? How about we slow down the pace of growth of investment and just see what works, see what's working for us? Even that was an existential risk. When you're priced to perfection, you better deliver perfection. And to some extent, NVIDIA had been. And now this challenges that notion.
Steve, you put out a really nice piece on Monday during this route. I'm always impressed with that you can pass the pieces the way you do. You talked about an inflection point rather than a turning point. Just dig into that for the viewers, please.
Sure. Again, as I was trying to process it, one of the questions I have, as a trader, investor, strategist, is what am I seeing here? And one thought was, is it a blip? I'm going to go with no, unless it's proven that DeepSeek is BS. And I wasn't going to go that far, and I still can't. And it was too big to be a blip anyway. You don't take just under $600 billion out of the largest company and just say, oh, it's a blip. Although yesterday the stock rallied quite a fair amount. I think a lot of people were hopeful that it was. Is it a turning point? Again, way too early to say it's a turning point because I don't think it invalidates the idea of AI. As I mentioned earlier, I think it actually, in some ways, makes it more accessible and accelerates the time frame under which it might become more pervasive. Its benefits might be able to trickle down into smaller companies that might have had to really wrestle with the idea of, can I afford to buy these big commercial models, or can I get away with some cheaper alternatives and get those efficiencies? So that's why I call it an inflection point. The trend hasn't necessarily turned, which would be a turning point. So you have an uptrend that turns lower. But I think in terms of AI, the overall path hasn't changed, but the pace of that path has likely changed. And as a result, potentially some of the winners and losers have changed. And this will be the story that we're going to have to resolve. I think really the turning point, you might be able to call it a turning point if we get proof that there are other deep seeks that can be more easily verified. I think also sitting in the US on the heels of the TikTok issues, I think there's certainly a lot of the same commentary about DeepSeek came out. And I think that's really secondary to what the story is, but it's hard to separate it. So I don't know, let somebody in America come up with one. Let somebody in Belgium come up with one. Let someone in pick your country that doesn't bring these political calculations into play and is more comfortable showing their work, so to speak.
Steve Sosnick, Chief Market Strategist at Interactive Brokers. Thank you very much for joining me today. And don't forget, to the audience, remember to subscribe wherever you download your podcast from. Thanks, Steve.
Thanks, Andrew. Take care.
Right. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.